Silver hit that 4-year high and then backed off. That's not the high. We're going higher. We're going to take out the high from 2020, which we haven't even taken out yet. That's around 34 and change. But once we take that out, silver could hit $50 this year. Gold could hit 3,000 this year. In fact, if it continues on its current trajectory, because remember, we're not even finished with the third quarter yet. We're almost there. But if you take the gains in the first three and extrapolate them into the fourth, we're pretty close to 3,000. That's a big number, even though I think we're going a hell of a lot higher than that, but it may be the type of number to wake people up. But while they're still sleeping,
as precious metals continue their strong performance in 2024, silver has emerged as the unexpected frontrunner, outpacing even gold's remarkable rise. While gold has been making headlines with consecutive record highs, silver quietly achieved its highest weekly close in 11 years, settling at $31.816 per ounce for December futures contracts, a 1% increase from the previous week. Silver prices have surged by an impressive 32%, eclipsing gold's still notable 29% gain. This stellar performance has caught the attention of investors and analysts, including renowned economist Peter Schiff. Schiff, CEO and chief global strategist of Euro-Pacific Capital, has made bold predictions for both metals. If current trends continue, he anticipates silver could reach $50 an ounce, while gold could hit $3,000. These projections come as China announces its most aggressive stimulus package since the 2020 COVID-19 pandemic, which analysts believe has fueled strong demand for silver. While precious metals soar, gold mining stocks have lagged behind. Schiff points out this discrepancy, noting that despite gold hitting an all-time high, those who bet against gold mining stocks profited last week. However, he believes these opportunities won't last, as eventually, these stocks will catch up, leading to a significant upward move. The GDX Gold Stock Index reached its highest level in nearly 4 years, closing at $41.41, with a 7.2% surge this month. Many believe gold stocks should be trading even higher, given gold's record-breaking gains. The main obstacle appears to be traders' apathetic sentiment toward the sector, although there are signs this may be starting to shift. Be sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
all the week's gains eradicated in a single day because gold was down 16 bucks, right? Again, everybody is scared that gold's going to collapse. It's far more likely that it's going to take off. And as I've been saying on this podcast all year, the whole time gold's been going up from 2,000 to almost 2,700. I keep saying, get ready for a big Sunday night. You know, we haven't really had it yet, but we're going to. I mean, I am convinced that the biggest move we're going to see in gold is going to happen when Americans are still asleep. It's going to get started in Asia. And so Americans are going to wake up to this crisis. And so what you want to do is go to bed protected. And that's why, you know, you got all weekend to go to shiftgold.com and load up your shopping cart with gold and silver. So I would go to the Shift Gold site over the weekend. Today, you know, Friday, Saturday, you could buy all weekend and buy some gold, buy some silver, and come Monday morning, if we haven't had a big move up in the gold stocks, then you'll maybe get a good deal on my gold fund. But regardless, right, I think we're going to have a big week. In fact, normally, again, the gold stocks, I said earlier, lead the metal. This time, they've lagged the metal, but they've been consistently wrong, right? If people have been looking at gold stocks as a indicator of where gold's going to go, and they say, oh, gold stocks are going down, that's signaling a drop in gold. They've been wrong. But you know what? Last Friday, if you thought that gold was going to go down this week, and you shorted the gold mining stocks because you were convinced gold was going down, and so you wanted to short the gold mining stocks, if you covered on the close today, you actually made money on your trade, even though you were 100% wrong. Gold went up 1% and made an all-time record high, yet you still made money shorting the gold stocks. Now, the market is not going to be that forgiving for long. I mean, people are not going to make money being wrong on gold and shorting these gold mining stocks. I mean, there's going to be a point where they're going to go ballistic. I mean, we should have already got there. We're not there yet. It is going to happen. But again, I just look at the lack of conviction in this trade as more proof that we are so early in this bull market. That's the crazy thing. You could buy gold at almost 2,700 and you're a contrarian because people think, well, why buy it? And people still want to buy the tech stocks, and they still believe that everything is great. They still think we got a soft landing, that the Fed, performed, the miracle. They avoided recession. They put the inflation genie back in the bottle, right? It was a masterful, display of central banking. These guys are all a bunch of geniuses. Aren't we so lucky that we have the smartest people in the world that happen to be working on the Federal Open Market Committee?
Last week, the Federal Reserve announced it had begun cutting interest rates to adjust monetary policy, aiming to maintain a strong labor market as inflation eases and the economy remains relatively stable. Many view this as the start of an easing cycle designed to achieve a soft economic landing. However, a recession could hit as early as this year, potentially forcing the Fed to cut rates more aggressively from the current 4.75% to 5.0% range, which could eventually lead to a return to quantitative easing, QE, a bond buying process typically used during market instability when rates approach zero to support the economy. Peter Schiff argues that the Fed's rate cuts have not successfully impacted long-term Treasury yields, making a return to QE more likely. He anticipates that the gold market will continue to rise in response to this shift, though mainstream analysts may be underestimating the broader implications. Such a significant rate cut signals that Fed Chair Jerome Powell and his colleagues are aware of deeper economic issues. Even with a half-point cut, whether the Fed can avoid a recession is uncertain. If post-COVID inflation persists, further rate cuts and another round of QE could worsen inflation, potentially causing it to surge. Now, let's return to the interview.
And, the dollar index, even though it was down on the week for the fourth consecutive week in a row, we had a falling dollar index, which is also bullish. The dollar index closed at 100.42. But in particular, the dollar was very weak today against the Swiss franc and the Japanese yen. We're barely hanging on to an 84 handle against the Swiss franc. And I think the fact that you're seeing this kind of weakness relative to the Swiss franc and the yen, right? These are the currencies that are perceived of as like the safe haven, right? When they talk about the cleanest dirty shirt in the hamper, they're really talking about the Swiss franc, because the Swiss franc is a lot less dirty than the US dollar, but also the yen. People tend to buy yen when they're worried about stuff. And the fact that people were rushing into the yen today, rushing into the Swiss franc today, that shows me that there's a lot of nervousness out there about the dollar. And the dollar is not a safe haven when people who own them are selling them to buy Swiss francs or to buy Japanese yen or to buy gold. That's why gold is going up, and that's why the Swiss franc is going up. People are looking for safety, and they no longer consider the dollar to be safe. They no longer consider treasuries to be safe. Again, treasury yields did go down slightly on the week, but you could barely notice the change. And in fact, since the Fed cut rates, yields on 10-year and 30-year treasuries, they've gone up. And they're going to go up a lot more. That's why I know the Fed is going to go back to QE, because the Fed wants lower interest rates. That's why they cut rates. Why do they want lower interest rates? Because they know the economy's in trouble and they want to rescue it with lower rates. So they cut the Fed funds rate, but it didn't produce an effect on the long-term rates because they had already discounted those cuts before they happened. But now that they have happened, long-term rates are going to head higher, and that is going to confound the Fed. They want them lower. And the only way they're going to get them lower is to return to QE. Now, there are people, I mentioned this, I think, on an interview, when I said I thought when the yield on the 10-year Treasury is back above 4%, that's going to result in the Fed going back to QE. And they said, well, but they got to 5% and the Fed didn't do QE. That's true, because then the Fed wasn't as worried about the economy as it is right now. The Fed was still hiking. But now that they're cutting, it's because they're worried about the economy. And so therefore, they don't want interest rates to go up. They wanted interest rates to go up back then. They don't want that anymore. And so when interest rates go up, when they want them to go down, they will go back to quantitative easing. And that, again, is the real reason that gold's going up, because the gold market is looking forward to QE. And the people in the mainstream media who are looking at it still don't get it. They still trust the Federal Reserve. And that is also one of the main reasons we've been able to get away with all these deficits and the artificially low interest rates and the QE programs, because at the end of the day, the market still trusted the Fed. And they actually still do. People still have confidence. You can look now at the break-evens on tips. If you don't know what these Treasury break-evens are, this is a spread between what you get on a Treasury inflation-protected bond and what you get on a regular Treasury. Now, you get a lower rate on the tip because you get the kicker of the added payment based on the CPI. So if you compare the yield that investors demand on a Treasury without inflation protection versus the yields that they get when they have that protection, you get what they call the break even, which is what inflation has to be before you break even on buying tips.
Investors are closely monitoring future opportunities as silver continues to outperform gold and other precious metals. Silver has reached its highest level in over a decade, and there are predictions of further gains for both silver and gold, indicating the market's potential for upward movement. However, the economic outlook remains uncertain due to inflation concerns and the possibility of additional rate cuts. Given the ongoing rise in silver and gold, do you believe these metals will maintain their momentum, or are we approaching a turning point in the market? Share your perspective in the comment section. If this video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.